Good morning, everyone. Welcome to the Vetiva breakfast meeting. In today's session, we have a special guest joining us, Michael Famarati, who will be speaking to us on Nigeria's debt sustainability in a few minutes. But before that, we'll be having the usual rundown of the equity and fixed income markets, as well as other African market updates from our media partners at Frontier Africa Reports. Before we begin, we'd like everyone to note that the session is being recorded and may be shared with third parties. It is also being streamed on Facebook on our Vetiva online Facebook page. And lastly, the session is expected to last for only 30 minutes, inclusive of Q&A. And this will hold after the presentation. As such, if you have any questions during the presentation, you may use the Q&A box, or you may drop them as comments in the chat box or the comment section on Facebook. With that said, we'll kick off the session with Sean from our Global Equities Desk. Hello, Sean.
Good morning, Chima, and good morning, everyone. So quickly, we take a review of the performance of some markets in West Africa, that's the BRVA, the Ghana Stock Exchange, and the Nigerian Stock Exchanges, and also our outlook for the session for today. So we start off in Ghana, where the index closed marginally higher by 1 basis point. It was another quiet session, just like the previous day, with the turnover declining 48% compared to what we saw in the previous session. Total Petroleum was the lone gainer in the market, as the year-to-date return improved marginally to 24.71%. So going into the day, we expect another quiet session as investors continue to process the decision of the Ghana MPC to reduce the anchor rate. So we move on to the BRVM. The composite index, unlike in Ghana, ended the session 28 basis point lower, as investors took profits on some of the names, like Nestle, Onatel, and they have, as we've seen, that they've appreciated significantly in recent sessions. Activity level also closed lower, with a 40% drop in both volume and value traded in the market. The year-to-date return also moderated to 7.22%, which is on the back of the loss that we saw in that session yesterday. Going into today, we expect a mixed trading session as market players continue to take profit on some of the names, while cherry-picking sound counters that haven't seen much upward movement since the rally we have seen in that market recently. So finally, in Nigeria, the market ended 2 consecutive days of gain to close lower in yesterday's session, as the benchmark index began the month of June on a negative note, closing down negative 6 basis points. Seplat, Zenith Bank, WAPCO, Dan Sugar, just names across all sectors were all under pressure as they all closed lower. Speaking to activity level, this improved as volume and value traded were up 36% and 24% in the session for the Nigerian equities market. So quickly going into today and our expectation, we believe though the market breadth turned marginally positive yesterday with 17 gainers and 16 decliners, which signals some sort of improvement in investor sentiment. But for us, we however expect the market to remain pressured as turnover continues to shrink, while investors continue to bid their time in the equities market. Overall, we expect market to continue on the same pattern as in recent session, which is a quiet session with mixed outcome. So that's what we're expecting for today. Thank you very much, and that'll be it for equities market.
Thank you very much, Sean. Next up is Omarege on fixed income and currencies. Good morning, Omarege.
Good morning, Chima. Good morning, everybody. I'll be taking a recap of yesterday's activities for the Nigerian fixed income market. I'll start with the money market. There was no official liquidity figures for yesterday. However, the official figures for Monday was released. Opening liquidity figures for Monday was about 256 billion positive. We believe that system is still in the positive region and estimate opening liquidity figures to be around 300 billion positive on the back of the OMO repayment of about 55.46 billion that came in yesterday. As a result of the improvement in system liquidity, money market rates losing by over 50 basis points to trade around 12% levels from the 12.5% levels that were recorded on Monday. We expect the money market to trade at lower levels today in the absence of any significant funding need in the market. Moving on to the FS market, the parallel market continues its march towards the 500 Naira to a dollar mark as it lost about 3 Naira yesterday to trade at 498 Naira to a dollar, while the earning window traded at a of 420.33 Naira to a dollar, closing flat at 412 Naira to a dollar. The earning industry turnover decreased marginally by 22.7% to close at $96.91 million from the $125.44 million recorded on Monday. We believe the Naira will continue to hover around these levels in the absence of significant inflow of FX into the system. Moving on to the Nigerian Treasury Biz market, the T-Biz market recorded another quiet trading session yesterday with few trades consummated across the benchmark curve. The maturity that enjoyed the most action yesterday was the newly issued special NTB, that's the August 30th, 2021, with a lot of trades debt on that end at around 7% levels. We also saw slight bearishness on the long-dated OMO maturities as offers were slightly above 9% levels on those maturities. In the NTB spectrum, there was mild demand for the one-year paper. As a result, offers on that one-year paper maintained to trade around 9.3% levels. We expect the T-Biz to trade on a quiet note today in the absence of any major change to system liquidity. I'll conclude with the Nigerian bonds market. The bonds market continued to witness moderation in rates as paucity of offers persist. The most sought after paper yesterday was the 2029 maturity. Despite the strong demand on that paper, there was really no trade consummated on that end as offers on that maturity was scarce. We believe the significant demand on that majority is largely as a result of a lot of players trying to cover their short positions. We also saw demand on the 2026 maturity at around sub 13% levels, precisely at 12.7% levels, but there were really no visible offers on that end. There was also mild demand on the 2027 maturity with few trades consummated on that maturity at above 12.9% levels. The long end of the benchmark curve, the 2045, 2049, and the 2050 also witnessed some buy interest with bids hovering around 14% levels. However, offers were around sub 14 levels. Despite the interest seen on the above maturities, activity was weak yesterday because of the lack of corresponding offers. Overall, it was a quiet trading session with few trades consummated across the benchmark curve. We expect the current sentiment in the bonds market to persist in the absence of significant offers across the benchmark curve. That concludes it for fixed income. Thank you very much.
Thank you very much, Marigib. We'll now move to Temple and Shadri for quick updates on African markets. Good morning, Temple.
Good morning, Chima. Good morning, listeners. And we've got in the eastern part of Africa, Kenya's inflation number came in recently. It's climbed again by some 5.9% in the month of May from 5.8% in April. Of course, a couple of factors, as we know, have contributed to that. The whole tax policy and crude oil price, petrol price rather, which they've been seeing a bit of back and forth on in recent times. The Africa Development Bank has also just signed an agreement with Tanzania. They signed a $140 million loan with them for the funding or financing of the 50 megawatts hydropower projects that they have in one of the major parts of the country. $20 million of that money actually came from the Growing Together Africa Fund projects, which is a $2 billion scheme that the multilateral financial institution, as we know, have been running lately since 2018 when they launched it. We all know that the OPEC Plus meeting started yesterday. Part of the fallout of that meeting is that they're going to be maintaining existing production measures at this point, with the possible plans that they will be easing between later this month, June, and then July next month. The reason they're holding up to these current production measures is basically because Iran is also expected to come on board any moment from now in terms of production and exports. And of course, we know that crude oil price has been appreciating in recent times. FBN Quest PMI data came out. It dipped. PMI for the month of May dipped to 51.1 reading versus 53 in April. And in Ghana, ExxonMobil has just pulled out of the exploration activities. We understand that ExxonMobil actually holds up to 80% stake in the Deepwater Cape 3 Points block, but their exit from that project is due to the fulfillment of their own contractual obligations. And of course, cryptocurrency is in the news again. In Ghana, the authorities there are basically warning investors and miners generally to be careful, to be aware of cryptocurrency investments, and just basically invest at their own risk. In South Africa as well, we know that the South Africa Revenue Service has just approached three major crypto miners and exchanges in the country. That would be Altcoin Trader, Luno, and VALR. They've basically approached them to be able to get details of key customers info and for the purpose of taxation, so they can tax better, because in 2018 or thereabouts, the Revenue Service also came up with a statement asking for the miners and exchanges to be more careful and be up to the game in terms of taxation for all those that will be buying from the participating in the purchase, in the buying and selling of cryptocurrencies through their own exchange, these three key services in the country. So basically, that is ongoing. We don't know who really approached each other, because there are some reports that say it was the exchanges that approached the Revenue Service. Some other reports says it was the Revenue Service that approached the exchanges. But basically, we know that it all boils down to taxation. There's also the unemployment data for South Africa for the first quarter of this year. That is out. It rose by 0.1%, just a marginal increase to 32.6% in the first quarter of the year. And that's like the highest, as we understand, since the launch in 2008. And the number of people that are unemployed in South Africa remains 7.2 million people. That was about the same figure that they had as at the fourth quarter of last year. So it hasn't really changed much this period. These are the headlines we have to share this morning, and thank you for listening.
Thank you very much, Temple, for those updates. We're now at the highlight of today's session, as in a minute, we'll be hearing from Michael Famarati. Michael is the chief economist and the head of the STARS data team. He's an economist who spent a number of years researching the Nigerian economy and identifying data gaps in the market as the chief economist at Vetiva Capital. Michael is the author of numerous industry and sector reports on the Nigerian economy, and he's here with us today to speak on public debt sustainability as a constraint to Nigeria's development. Good morning, Michael. Thank you for joining us. You have the floor.
Good morning, Chima. It's wonderful to be here. Thanks again for inviting me. It's always lovely to be back amongst old friends. As Chima mentioned, today I will just quickly run through an issue that, amidst everything else going on in the political, economic, and security space, may sometimes fly under the radar. And this issue is Nigeria's debt sustainability and to what extent it constrains or affects our medium-term development. Just kicking off, I'll actually start off with the message that I want to pass across today. And that message is very simple. The message is that Nigeria is at a fiscal cliff right now, and that constrains the amount of impact that the government can make in the economy. Now, if there is no change over the next few years, then Nigeria faces either of two crises, either a debt crisis or an inflation crisis. Now, having delivered that message, I will walk us through how we got here, what exactly this crisis looks like, and what the likely outcomes are. In terms of how we got here, there are two things to note, right? The first is that there were structural factors that led us here, right? I'm sure everybody in this room is familiar with Nigeria's famous dependence on oil. Just to put that into context, between 2010 and 2014, about 3/4 of all revenues that flowed into the Federation accounts came from oil. And this was obviously during the peak, the boom of the oil era. At the same time, between 2010 and 2014, Nigeria, the federal government at least spent about 60% of its spending budget on non-debt recurrent spending. So things like salaries, overheads, and so on, right? So before the crisis hit, we had a bit of a bloated government, essentially. But beyond the structural factors, we also made certain decisions that brought us here. One of them is that in response to the oil price crash from 2014 to 2016, the Nigerian government decided to go with an expansionary fiscal policy where they would spend their way out of the crisis. Let's put this spending spree in context, right? Between 2010 and 2016, the federal government spent between 4 trillion and 4.7 trillion naira each year, right? So for a 6-year period, spending was consistent around 4.5 trillion naira. From 2017, the federal government then spent 6.5 trillion. 2018, they spent 7.5 trillion. And in 2019, they spent 8.3 trillion, right? So from varying between 4 to 4.7 trillion in 3 years, they were spending nearly double that just when revenues had taken a hit, right? So the combination of these structural factors and decisions that we made brought us to this point. Now, what exactly does this debt sustainability problem look like? I'll approach it from two angles, right? The first is the size of debt itself. Now, the first thing that I would admit is looking at Nigeria's debt to GDP ratio, there doesn't seem to be too much of a concern yet, right? So Nigeria is still well within any global thresholds for debt to GDP ratios. However, that ignores the trend that we've seen so far. Again, over the last 4 years, Nigeria's debt burden has tripled from roughly 11 trillion naira to about 33 trillion naira, right? So again, that's a trend that gives a very different picture of our debt to GDP ratio. More worrying actually is our ability to service this debt, which I imagine is not a new issue. But again, putting this in context, before 2014, Nigeria was spending about 30% of its revenues servicing its debt. By 2020, that was 83%, right? So for every naira that the federal government earned, it spent over 80 kobo just repaying debt. And again, just putting the trend in perspective, in the last 8 years, if you look at every major line item in the government finances, nothing has grown faster than debt servicing, which has grown by 8 times in the last 10 years, right? So again, that puts into context just how severe our debt situation is. Now, having illustrated what the problem is and what it looks like, what opportunities do we have to get out of this? Well, there are 3 possible paths. None of them is particularly attractive, but we'll walk through each of them. The first one is that the fiscal authorities put a rein on spending right now, right? So some sort of austerity. Now, naturally, this comes at a bad time, right? The COVID pandemic has just hit, and quite frankly, the economy has probably not even recovered from the 2016 recession, right? So any austerity at this time is unlikely going to be very helpful. At the same time, it's very important for ensuring sustainability. Now, the one caveat with austerity is that if you're going to go ahead with it, you ought to pair it with the types of reforms that people have been crying out for a long time, right? So on the energy side, on the FX side, and so on, right? So if you're going ahead with austerity, it just makes sense to couple it with, again, more long-term reforms that sets the economy up for a post-austerity recovery. Now, believe it or not, that's the good way out, right? Nigeria itself deciding to rein in spending. The other possibilities are a lot more negative, right? And the first is that we essentially persist on this path where a lot of the government deficits is being financed by the CBN. And essentially the long-term outcome is much higher inflation. Now, when we speak about inflation because of, CBN financing, there's a tendency for people to think that we're thinking about inflation of 200%, 500%, and so on. But the reality is that Nigeria does not need to move too far from its current levels of about 18% to get to a point where inflation is being severely harmful to the economy. Already today, we know that there is a significant flight to the dollar because people are tired of their wealth being eroded by the fall in the value of the naira, right? So when you have inflation at 40-45%, that type of thing becomes even more common, and essentially monetary policy even loses its power because a lot of the economy is switching to the dollar, right? So that again is a very quick snapshot of what that situation can look like. The final possibility is that Nigeria enters a full-blown public debt crisis where rather than it's being insolvent, that is, it can't pay back its debt, it just stops being liquid and is unable to service its current debt. Again, I will point out that we are not too far from that, right? In Q1 2020, if I believe, the government was spending about 95% of its revenues on debt servicing, right? So all it takes is a few more years and we get to a point where all government finances are being diverted to debt and we still can't pay down that bill. What happens after that is a credit crunch and something that looks like Greece, where the economy falls into austerity, and this is a lot more severe. To show how bad that can get, in 2011, the Greek economy shrank by about 10%, right? And over that debt crisis period, the economy lost about 25% of its real value, right? So that's sort of a worst case scenario. So again, just to recap, we are at the fiscal cliff where already right now our debt is showing signs of being not sustainable. And if things persist, then we're going to have to bite the bullet and face either of these three negative situations. I'll stop here now and open the floor for questions.
Thank you, Michael, for a very wonderful presentation. So our listeners, we are at the Q&A segment, and as mentioned earlier, you can use any of the comment sections for questions. Also, if you're joining us on Zoom, you have the option to use the raise hand function. Already, we have about 2 questions in the comment sections or in the Q&A boxes, and we have 2 hands raised. So I'll take the first question in the Q&A box. Is the bigger danger of poor debt management not a debt crisis and inflation, and possibly hyperinflation, as opposed to a debt crisis or inflation? If you take that first, Michael.
Yeah. So completely correct. These situations are not as mutually exclusive as they've been presented. However, one thing to note is that the severity of either the debt or inflation scenarios depends on, one, the kind of debt crisis you have, and then 2, the decisions made. So what I mean by this is that a lot of Nigeria's debt is still Naira denominated, right? And in fact, when you look at debt servicing, 83% is domestic debt. Now, in that situation, given how aggressive the government has been on the fiscal side, it's more likely that they respond by trying to pay down the debt by printing more money, therefore making it more likely that, as opposed to getting to a point where we can't actually service the debt, we are servicing the debt, but it's coming at a cost of much higher inflation, right? So even in that scenario, we would still be in a situation where, in real terms, our debt isn't sustainable, but we're papering over the cracks just by printing money, and the near-term effect is much higher inflation. So I hope that sort of gives you a sense of how we might move between the different scenarios.
Thank you, Michael. Our next question will be from Onyeka Ijoma.
Okay. Thank you, Michael, for the presentation. I think the most obvious question here is, how do we get out of this? You talked about the pandemic coming at the wrongest time, and so austerity measures might not necessarily be the best line of action now. And in order to boost our revenues, to at least bring down the cost of debt servicing, at least per revenue, we would probably need to borrow more money and invest it in productive assets, which would increase our debt servicing costs even more. So, I mean, in your opinion, what's the way out here for Nigeria?
Yeah, you're absolutely right. In one sense, we are too far gone to get out of this without some type of harm. And my recommendation would essentially be to take the first approach and bite the bullet now, and essentially face some type of austerity that means that, quite frankly, on both the fiscal and monetary side, the government wouldn't be doing much to stimulate the economy. Now, while that sounds pretty bleak, one reason I am also in favor of that is that if you look at the interventions taken in the last 5 to 6 years as well, they haven't been particularly effective. and they've come at a very high price. So I guess what we would be giving up is not as large or significant as if government policy had been, doing well to actually support the economy today. So in a nutshell, it would essentially be take the near-term pain of austerity until you can tidy up your books and perhaps begin to build a culture where non-oil revenue is stronger, because quite frankly, in the long term, you don't have a sustainable fiscal base without that. And we are still quite far from achieving that.
Yes, thank you, but I know others have a few questions, but just one quick follow-up question here on that. And that's, do you think we can actually afford to take those austerity measures? I mean, move out, like outside of Lagos, for example, the economic conditions are significantly worse. And even looking within Lagos, we already have sizable, a lot of people under the poverty line, people not being able to even afford the basic necessities. So the austerity measures might affect a lot more people than might be able to sort of bite the bullet. And all, do you think that we can actually afford to go down this route? Because I mean, the more we go down this route, the less likely, the less attractive the economy is for investment.
So Nigeria is essentially between a rock and a hard place. Nobody likes the rock. Nobody can afford the rock. But quite frankly, the alternative, although it's a bit further down the line, is even worse. So really, in terms of whether or not we can afford to take this path, quite frankly, no. It is going to be very, very painful for everybody, regardless of region or social class or industry. But the reason it's a viable path is essentially that the alternative is just much worse, and it's very easy for us to keep kicking the can down the line, because quite frankly, that's what has also gotten us here in the first place.
Thank you very much.
Thank you very much, Onika and Michael. I think we have a last question here from Babatunde, and he's saying Nigerian economies are not talking enough of the harm in the over 3,000 BDCs, which are just tools for arbitrage and causing the severe drop in Naira-dollar exchange rates. Please, your comments.
Yeah, it sounds to me like there's a lot more behind that comment, but essentially my perspective is that BDCs are simply just one market player in the FX markets, and most of the illicit or unhelpful behavior that we're seeing in that space is a function of the systems and incentives put in place, right? So you have BDCs in other countries and they function well. They aren't an issue to be discussed. If you have a situation where BDCs or any other market player is becoming a problem, you then have to take another look at the incentives that have been put in place in the market. And I mean, for the last, 5, 6, 7 years, we're quite familiar with the types of conflicting and very strange incentives that the central bank has put in that market. And that's why you're seeing lots of people acting rationally, essentially, by trying to exploit any gaps that they might find in the market, right? So as opposed to focusing on the individual players, I would instead place an emphasis on making sure that we're getting the market's incentives right, which we have not since 2014, 2015, really.
Thank you very much. I hope that answers your question, Babatunde. We are at the end of the session today. Special thanks to our special guest, Michael Famarati, for taking time out to speak with us with valuable insights. We also thank all our attendees for joining us today. We encourage everyone to continue to stay safe, and we'd like to see you same time tomorrow. Thank you for joining and good morning.
Thank you very much. Have a wonderful day.